And welcome back to the Lance Roberts Show podcast, right here at realinvestmentadvice.com. As Hurricane Michael makes landfall on the eastern shoreline, 155 miles an hour of Florida Panhandle, Michael Lebowitz, Hurricane Michael, I guess, on Skype with us today. Michael, how are you, sir?
I'm doing great, Lance. Thanks.
So, this is something that you and I have been talking about now for a while, is that it's been quite interesting that, interest rates have been going up. And, previously, every time we've gotten around that 3% interest rate, the markets have kind of woken up to the reality that, hey, this really isn't good for stock markets in general. You start getting yields higher than the dividend yield on stocks. There is an alternative to investing in stocks. And it seemed here for a moment that as we got above 3% this time, that, well, maybe this time was going to be different. Markets really kind of seemed to ignore rates that were going up until today. What are your thoughts?
Well, the last few days, let's forget about today for a second, but the last few days were very interesting. We would come in and either the market was down, the S&P was down 15 or 20 points, or it was shortly after the open. And then by the close, it had rallied itself back to slightly green, slightly red, basically flat. And we had seen that same pattern for 3 or 4 days. And today we come in and it's down about 20. And it just kept going. It was down about 40 for a couple hours around noontime, and it slipped after that. What's a little different about today is there is no news. There's really no news to talk about that would have caused such a big drop. Yields did rise slightly, but it wasn't anything that meaningful. So you just wonder if the last 3 or 4 days were a precursor as to what was going to happen today, where the buy the dip worked, but it didn't work quite as well as it has in the past.
Yeah, I think that's an interesting point, because when we talk about the markets, and this is one thing that we've warned about numerous times, is this whole risk of passive indexing and ETFs and the liquidity issues that go along with that. And we kept saying that as long as these algorithms are willing to buy the dip, right? And so every time we come down to support, and we saw this over the last few days in particular, we came down to support and there was this buying that would just automatically come in and as you said, it would push the markets back up to even. And of course, the question has remained that, well, what happens if you break a level of support that triggers these algorithms to start selling instead of buying? And, that's kind of what we saw happen today, is that once the selling began, there was no recovery. We didn't see an opportunity for these support levels to hold and for them to rally. And then as the liquidation began, you started getting sell-offs in ETFs. And of course, that requires further liquidation in individual securities. And it's interesting. Look at what's happening with the previous leaders of our markets from the beginning of this year. Amazon is in full-fledged correction now. The stock for hedge funds has been Amazon. Nothing, Amazon can do no wrong. They're going to rule the world. And yet, over the last couple of months, that stock's now fallen into a full-fledged correction.
Right. It's there's definitely been an undercurrent to the market. And it's really starting to show itself on the surface at this point. And again, with there not being much news today, it tells me that traders were coming in skittish, that algos may be changing their patterns. We have to remember, too, that algos do not have feelings. They don't have emotions. They're just computer programs that learn, and they're constantly learning and constantly changing. And while those algorithms were providing great support to the market, there's nothing that says that they won't provide great support to the downside. Their job is to make money. Their job is not to push the market in one direction or another. Lance, was another tell today, too. Bonds closed the day about flat. Mm-hmm. Typically, when you see a day where the market's down 2-3%, bonds will rally 2 or 3 points, sometimes even more. Mm-hmm. And they just didn't have that pick-me-up today, which tells me that the bond market, well, I personally think, and I think you do too, is pretty close to reaching a high-yield watermark here. There still may be a little more to go in that respect.
Well, we've got an article coming out tomorrow actually talking about the bond market, and you did some very interesting analysis that's in that article tomorrow, which is, we talk about this record net short position in bonds. So in other words, we have everybody in the world bearish on treasuries. And the question becomes, well, how far do interest rates have to rally here? In other words, if we get below 3%, if we get below 2.9%, what is that interest rate number to where those algorithms that are short bonds begin to cover? And again, and once you start getting that short covering effect in the bond market, you're going to see substantially lower yields, and that has real implications for the overall market.
Right. But, there's still about a third of a point, about 30 basis points to go till we even get to those levels. So that would be a somewhat significant rally even to get to the point where those traders, algorithms, whoever it may be, has to cover.
So, here's the other thing, right? So, we have this really sharp sell-off in the markets, and we've seen these before in the past where we have the markets that are down 2-3%. These things typically precede bigger corrections. So I think it's hard to say that, while the markets are down, we're deeply oversold on a short-term basis. It's very likely we're going to see a rally in the next day or so. Simply, there is still that overall psychology of buy the dips. The Federal Reserve is going to bail everything out. I wouldn't be surprised to see some Fed official trot it out over the next couple of days to try to calm the markets. Maybe a tweet from the president himself to try to calm the markets. And so you get a rally, but whatever rally you get, if it fails, it certainly suggests that we're going to have lower lows to come.
That's the key right there, Lance. There will be a buy the dip, whether that's tonight, whether that's tomorrow, or maybe even it'll be Monday. When that occurs, we have to watch that carefully to see where it gets to. Does it get back up above levels where we were today or yesterday, or does it fail about, do we rally about 30 or 40 S&P points from here and then start failing again and reaching lower lows? But we're still a ways off from where we were last January and February.
Right.
So you can still argue there's plenty of room to go before we're even at those levels.
Well, and again, as I was talking about a second ago when I was doing the kind of the market overview, the one thing that we have done today, which is we've come down, and this is really something that has only happened a couple of times really since 2009 lows, is where we've come down and retested, or at least tried to test, that uptrend line, that bullish trend line that occurred all the way back from the June 2015, 2016 lows. And we're sitting right on that trend line today. So, if we break that support line, we could definitely see some lower lows. But to your point, we've got to go a fairly long ways to really suggest that the market trend overall has changed from bullish to bearish. And the question for investors is are you willing to suffer a 10 or 15% decline before you start taking action in the event we do change that trend? Or do you start taking some action now to hedge off the risk in your portfolio until you have a clearer definition of where we're headed to next?
Right. Bull markets are topping processes. When they end, it's a process. It's not a one-day event where all of a sudden it just starts going lower. And maybe January, February was the first act of the event. We might be seeing the second act. But the markets do tend to give plenty of warning. Look at 2007 and 8, for instance, where it gave almost a year's warning in various forms before bottom really gave out.
Got a question for Lance
what
later?
You really
Ask
want to look
now
for
at
are signs that this is a topping process and an end to the bull market. And those are the kinds of things that Lance and I are talking about and writing about.
Well, and again, it seems like a lot of the stuff that you and I have been writing about has fallen on deaf ears for the last couple of years anyway, because it hasn't seemed to matter, because the Federal Reserve has been, there to kind of support the markets. It's been a lot about liquidity in the markets. And, you've got a great piece out today talk about, has accommodation been taken out of the markets? The Fed's hiking rates, they're reducing their balance sheet. But even with that, accommodation to the markets in terms of overall liquidity is still very high.
Right. It's incredibly high when you compare it to the past. The Fed has a balance sheet that's just under $4 trillion. Prior to 2008, it was $500-600 billion at the most. Fed funds are only at 2% when you have the nominal GDP growth running over 5%. Mm-hmm. That's unheard of. And when you factor those two together, the amount of stimulus being applied to the economy, along with $1 trillion fiscal deficit, along with global QE on a scale just as big as the Fed's, and there's a huge amount supporting both the market and the economy. And when some of that stuff starts giving way, you better watch out.
Well, and again, I thought, one thing that was very interesting today is there was really no safe place to hide. And you kind of mentioned this earlier that, previously if, the markets are selling off, you generally see a bid into bonds, at least just for a safety, kind of a risk-off rotation play. And you really didn't see that today. You had the tailing 10-year auction that went off today was not great. There wasn't yields pushed up very little, a little bit. Again, it wasn't terrible. It wasn't a blowout, but yields did rise on the 10-year Treasury today a bit. And so gold was under a tremendous amount of pressure today. Emerging markets, international markets, there was really nowhere to go. The only place of safety that was really in the markets today that I could find was pretty much cash.
Right. Gold ended up green, actually, and bonds ended up slightly green. So there was a late day bid to some of those places where you'd normally hide. But again, given the percentage move in stocks, you would expect both gold and bonds to have really good days, and they didn't.
Right, and that was my point. Yes, they were up a little bit, but it's not what you would have expected to have seen.
Exactly.
And I thought one thing that was interesting today, though, utilities actually had a very good day today. They were actually green across the board. And, that's a very interest rate sensitive sector. And actually, utilities have been performing well over the last few days. They've been rising while interest rates are going up. So either investors are not buying into this idea that yields are about to take off to the moon on interest rates, or, they're just trying to find some place to stuff money. So they're sticking utilities for the yield. I'm not sure that traders are that naive to jump into a very interest rate sensitive sector that's particularly got very high levels of price to free cash, very, very high levels of price to cash flow, without respective understanding that yields are probably at their limit. I mean, what would you take away from that?
I think it's muscle memory that investors know they need to go to low beta sectors, and they pretty much just go there without doing the math, without understanding valuations. It's a gut reaction.
Interesting. So, with the markets where they are today, what are you kind of watching for here over the next couple of days?
Again, I mean, we are nearing some important technical levels, but until we get down to those January, February lows, this is nothing more than a consolidation. And it feels bad. Don't get me wrong. I mean, we're going to, there's potential to lose more, but until we break those levels, you really haven't broken anything of consequence. I would also mention that the corporations are currently most corporations are out of the market and can't buy back their stock. And that has provided a good bid to the market in the past when it was down. They will be back in the market in about 10, 15 days, which is a while, but we should keep an eye on that.
Yeah, and we're about to enter into earnings season, and estimates have been coming down, so it's still likely that we'll have a good beat rate on earnings going in the last 2 months of the year. And as I was saying earlier, with a lot of hedge funds and mutual funds kind of lagging behind the market so far this year, don't be surprised if you don't see them trying to bid up the markets here a bit. Getting in here, trying to play a little bit of catch up in terms of performance by year end when they have to post their returns.
Right. And again, I think the key is keep an eye on the bond market. And we've been talking about that for a while. We've been watching bond yields rise. And every day, Lance and I have the conversation that while yields are up again and no one cares, the market doesn't care. Well, it just had to hit a level where the market did care, and no one knew what that level would be. But we're at that level now. So if yields keep going up, the stock market will keep going down. So that's kind of when you wake up in the morning, that's the first place you should look are bond yields and what did they do overnight. I think that'll provide a decent amount of forward-looking guidance for the day and days ahead.
Yeah, I agree. All right, well, I'll tell you what, let's wrap that up. And Mike, thanks for your time today. We'll see you tomorrow at 3 o'clock.
Sounds good.
All right, see you, Mike. Mike Lebowitz, CFA, of course, realinvestmentadvice.com. You get his articles there every single day. And, of course, you always find our podcast there. Also, simply go by the website, realinvestmentadvice.com. Get this blogcast and all of them at the website now at realinvestmentadvice.com. Be right back with our special guest in studio. Don't go away.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.